I'm Kelsey Roberts, and I'm making this video because I believe America would be in better financial shape when more American households are in better financial shape. I believe a lot of people who aren't in good financial shape just don't know how to thrive financially, and I believe that they deserve it. I believe this information should be free and easily accessible. So, in the last video, I talked about how the traditional TSP is tax deferred and how you can use that to lower the amount of taxes that you owe and pay throughout the year. So a quick review, I did make some changes to this, just a couple. I annotated this, that this is what you're paying. In the 10% margin, this is what you're paying in the 15% margin, because when we started, before we added adjustments, we were paying tax. Snuffy was paying tax in the 15% margin. Now it's down to 0. And it's just in the 10% margin. So this is actually the tax that you owe. I just want to see how it gets there. I also I threw a formula into here, and I linked this to this. So whatever this is will show up here. I threw a formula in here just so we can play with numbers. Now this is dependent on this. It's basically whatever percentage I put in here of this will be. So if I say 5%, this is 5%, and this number will reflect, and then the adjustments will reflect, and then the AGI will reflect, and the tax will reflect. So we can play with the numbers and show what the difference is between overestimating, underestimating, why you want to do those two things. And you can already tell, 5%, this is a tax refund, $127. Put 6% in, the tax refund is $152. So we're already tweaking the numbers a little bit. I'm going to show you how those numbers are going to be a lot more tweaked very soon. So, really quick review: taxable income, gross income, which comes up here, gross income minus adjustments, which are all these things, TSP, exemptions, deductions, equals the AGI, adjusted gross income. And then the adjusted gross income is calculated in the marginal tax system, 10%, 15%, so on and so forth. And those margins are, so I think I closed the window anyway. All the way up to the top. Most military members are going to fall into the first 3 or maybe 4 margins. Okay. So you get your gross tax, and then you subtract credits, dollar for dollar from the gross tax. You wind up with your tax liability. So what we did in the last video was we used the TSP to reduce this number and get a smaller number here by 10%. So basically, for every dollar you add, it's reducing this by $1, but it's only reducing this by 10 cents on the dollar. There is a credit called the retirement savings credit. And I just Google search 2014 retirement savings credit. Alright, and here it is on the IRS website, the retirement savings credit. They call it the savers credit. So here's the rates for 2013, and we're projecting for Snuffy, so this is 2014 rate. And the credit rate is actually dependent on how much you put into your retirement. 50% of your contribution, 20% of your contribution, 10% of your contribution, and then 0. And that's dependent on how much you make and how you file. So if you're married filing joint, and your AGI is not more than $36,000, then you will get back as a credit 50% of how much you put into your qualifying retirement. And now this is traditional and Roth. Okay, so traditional is going to reduce your AGI. It's going to act like an adjustment. But when we start talking about the savers credit, this is your traditional contributions and your Roth contributions. All right. And the maximum amount of credit for this is $2,000 for people married filing joint, and $1,000 for basically everybody else. There's some things that you got to look at in here. This is not the table. Let's see how complex this thing gets. Anyway, while we're waiting on that, I'm going to go back to this. So, this credit for Snuffy based on, I'm just going to go back. To get 50% of his retirement contributions back as a credit, his AGI is to be not more than $17,750. Remember, he's filing single, so 17,000. Well, here's his AGI, and that's definitely not $17,750. So his credit is going to be, his credit's going to equal his TSP contributions times 0.5 or 1/2. Okay, so now we're going to calculate how much he actually is going to get back on his tax return. I'm going to move this over here because there's some things that we got to do. Okay, here's the funny thing about the retirement savings credit. I'm just going to put RSC, retirement savings credit, and then I'll put child credit. Excuse me. Okay, this is your child tax credit. He's got a child, $1,000. This is your retirement savings credit, 50% of how much he put in there because his income wasn't over the $17,000 threshold. This is important. Okay, I know it sounds really complicated, but watch the video again, or just go back a minute and watch it again until you get it, because this is really, really important. The retirement savings credit is a non-returnable credit. All right, child tax credit, earned income credit, all of those are returnable credits. Okay, so what that means is if, let's say, your tax liability is $847 and you get a child tax credit for $1,000, then whatever is going to reduce your tax owed to zero, right? 1,000 minus 847 is, there's a $152 difference. So with the returnable credit, whatever that credit puts you below zero, you get that in the form of a check from the IRS. This is a returnable credit. The retirement savings contribution, or the retirement savings credit, is non-returnable credit. So what that means is, let's say this one was 1,000. Let's see if I can make it 1,000. Let's say 2,000. Right. This one is 1,000. All right, and the tax. Let's say the tax is $792. Now, if he doesn't have a child, I'm just going to move this out of the way. Okay, just quit imagining that. His credit is 1,000. His tax owed is $792. This will not be true. Okay, the retirement savings credit will reduce your taxes to zero, but not any further than that. You're not going to get this money back because you already have it. All right, it's in your retirement, it's in your TSP, it's in your IRA, it's in your 401k, it's in whatever your retirement fund is. Okay, you already have it. You're not going to get this back. But then, and okay, just so you know, the IRS isn't the bunch of bad guys that everybody thinks they are. Okay, this is the way that it works. They apply the non-refundable credits first, and then they apply the refundable credits, the returnable credits. Because if you apply the returnable credit first, all right, this is going to take you down to zero already, and negative zero, and then you apply this. It's going to take you down. It's not going to take you down any because you're already at or below zero. But if you apply this first, okay, it's going to take you down. It might take you down to zero. It might take you down close to zero. But then if you apply this second, it's going to take you below zero, and you're going to get more of a refund, all right, than if you were to apply this first and this second. So they're not as bad as everybody thinks they are, and it does work out better. Okay, so, oh, you know what I did? Yeah, I changed the formula in there. So anyway, 7%, 8%, whatever. So what this is going to do, the first thing that they're going to do, and I'm just going to split these up into returnable credit lines and non-returnable credit. Yeah. So the credit is that, okay? It's going to take it down to minus 176, so we're going to say 0. So your actual tax return, this is going to be 0 because you can't have a negative number on a non-returnable credit. So 0. So your tax return here is going to be $1,000 for the child tax credit. Plus, and this is something we haven't even got into, Earned income credit. Earned income credit is a really big formula. They use a lot of different numbers and a lot of different input conditions to determine earned income credit, and that's why I showed you the IRS withholding calculator, because that's what this does. That's what all of this is for, is to show you what the IRS withholding calculator does, but it's just a way that you can see it in front of you and to know how to manipulate those numbers in the withholding calculator to maximize your tax return and to be able to maximize your ultimately your income. So this is the second whammy. All right. So we went from $176 tax credit, applied the retirement savings credit, got tax liability down to 0, and then added a $1,000 child child tax credit. Got $1,000 back. That's whammy number 2. Stay with me. I'm going to do whammy number 3 in the next video and talk about income that can and will be tax-free for life. Thanks for watching. See you in the next video.